สวัสดีครับ Good evening Dear member and distinguished guests Good evening นะครับ My name is Anupong Chailat I am your MC tonight and this is my first time for MC as well Thank you On behalf of SPE Thailand Board of Directors I would like to welcome you to SPE Thailand technical meetings Thank you for your being here tonight, and we are happy to see many oil and service companies, government representatives, and academia from the upstream oil and gas industry support our events. Also, a special welcome to our students. Please raise your hands. Where students? Thank you for joining us. But before we continue with our program, please take note for this safety announcement a bit that no any drill tonight. So any case of alarm, so please stay calm and walk to the emergency exit. So here, this is our agenda, right? So we will have the presentations followed by Q&A and closing remark, which is we announce about SPE event and definitely lucky draw for tonight, which we have the special lucky draw from Rystad for 2 items. These companies are the sponsor who support us, our Thailand monthly technical meeting for the seasons. For any of you who may have just turned to this meeting, if you would like to see your company name in here, please reach out to us. We appreciate your support and of course, our society needs you. At tonight, even we hope to show you how to industry continue to create and innovate to meet our future energy need. The industry here in Thailand is unique and perfectly fit with SPE mission and vision. We, the network and we share. In 2023, we continue in our mission to keep you informed on what's going on our industry and make new knowledge available to you. With monthly technical presentations, tonight it is our honor to have Afiqah Ali, senior analyst from Rystad, to share us in the topic from the ground up and shaping the energy market in Thailand toward 2030. Okay, something different a bit, but that's fine. Okay, let's go back a bit for our members so you can see the trend. The event for tonight is not happen unless we have support from our member and also non-member to support our event. And this is the trend for our section, which is quite active. The section in Southeast Asia or Asia Pacific. So the benefit for the memberships that we will not read through all. Right? The first thing that this event make our networking, make our have good dinner, good drinking for tonight with the knowledge for the market. Okay, let's come to the main presentation. Right? I would like to invite Khun Kasian, our program chair, to introduce for the speaker tonight. Thank you.
ครับขอบคุณครับคุณอนุพงศ์ Thank you คุณอนุพงศ์ For those who just joined SPE Thailand, my name is Kasian. I'm the SPE program chair. We have come to the last meeting of 2023 now because next month we have a break, Christmas break. And this will be the 10th meeting of 2023. So we committed all the meeting to our sponsors. Thank you very much. So without further ado, let me start to do the speaker introduction for this evening. So the speaker tonight is a senior analyst under the Energy Services Research in the Supply Chain Research Department at Rystad Energy. She specifically focuses on energy supply chain research in supporting the research-related activities on energy services market in the Asia-Pacific region. Having started her career in the technical line with Petronas and then ExxonMobil as a process engineer, she then joined a government agency under the Ministry of Economy, MPRC in Malaysia, as an analyst to lead the energy framework implementation prior to joining the Rystad Energy. Her field of expertise includes the data monitoring and analysis, upstream and downstream operations, process design and risk assessment, project management, government policies, and strategy. Our speaker holds the master degree in chemical engineering from the University of Leeds from the UK and has over 9 years of working experience in the oil and gas industries. Ladies and gentlemen, please join me for a very warm welcome our speaker this evening, Ms. Afiqah Ali from Rystad Energy. That's yours.
Very good evening, ladies and gentlemen. First of all, thank you to Kun Kasian for the introduction. It is a pleasure for us at Rystad Energy to have this opportunity to do this kind of presentation, as well as be able to share our insights on the energy markets, especially to the esteemed members of SPE Thailand. Okay, and first of all, thank you so much for everyone for making the time to attend to this session. I'm Afiqah. I am a senior analyst on the supply chain at Rystad. So basically, maybe before we start, I can share a bit about the research team that I'm in. So basically, the research team at Rystad, we looks over the changes and trends in the supply chain across the different service segments that we cover. So on a macro and also micro level. And this is basically to kind of give a good estimates on the market share, market sizes, and also benchmarking on the suppliers. So we aim to provide a comprehensive coverage on the energy supply chain, covering the oil and gas as well as renewables, to kind of better support our client, especially on their strategic decision making as well as operation, as well as their operation as well. So, okay, sorry. So now let's start. So for today. So for this presentation today, I will cover on the trends shaping the energy landscape in Thailand towards 2030. So I have divided my presentation into these three parts. The first part is I'm trying to look at on macro level, what are some of the energy and outlook that we can expect in the near term, and then the second. Sorry, just kidding. And then the second topic I'll cover on the shift that we can anticipate in the energy industry that might affect demand and supply across the different service segments. Okay, so this is where I'm going to cover a bit on the trends in the oil and gas, as well as some of the service capacities that we can expect. And then I'll wrap up with some of the regional outlook across the key fundamentals of supply chain, looking to cover price, cost, and a bit of inflation as well. All right, so in a retrospective view of the past 2 years, we have seen the oil and gas suppliers have been seeing more cash flow than before than the past 2 years we have seen. So this is actually a sign that the oil and gas market is in a good condition, and this is predominantly driven by the energy security concern following the Russia invasion of Ukraine in the early of last year, as well as the bullish supply supply-side factors following the OPEC Plus supply cut since May this year. And this improved margin we are seeing has also resulted in an improved cash flow to the oil and gas suppliers, especially most prominent in the second half of last year, while it remains elevated going through the first half of this year. All right, so now the big question is what can they do? What are some of the potential that they can look at with this positive cash flow? Of course, we know that the cycle of good growth in the oil and gas industry will definitely last for at least few more years. Fundamentally, there are two scenarios to this. First, they can look to return this free cash flow by reducing their balance debt, or they can look to increase their dividends payout to their shareholders. And also, they can also look to invest for their next phase of growth by increasing their existing capacity, or they can also look to adopt more robust technology to improve their productivity. And there's also mergers and acquisition, whether to solidify their footing in the industry, as well as getting a head start to expand their business portfolio, tapping into the new energy segment. Okay, so for the past 10 years, So for the past 10 years, basically, we have seen that the oil and gas suppliers have not only been able to get back to what we see here. So basically, for the past 10 years, all these oil and gas suppliers are pretty much inclined, have more willingness to return this free cash flow that they have, whereby we have seen that the level of debt has been reducing quite consistently from the peak of 2020, the year when we saw spikes in debts due to the pandemic. And also, we have seen that an improved dividends payout to their shareholders, especially within the oil and gas suppliers. But we have seen quite a limited willingness to invest, especially on capacity, whereby perhaps this is a situation where they've grown more cautious over the range of investment that they can do, especially given the series of crises, especially within the oil and gas sector. And we basically expect there'll be more M&A in the coming few years, especially within the adjacent sectors like the hydrogen, CCUS, and also all these carbon reduction technologies. Okay, so overall, essentially, we can see that the suppliers are in a good position, given the capacity that they have. They can use this capacity to grow their business portfolio, tapping into the emergence of the low carbon sectors. All right, so that brings me to my next slide, where I wanted to show you what we can expect on the global spending in the energy sector. So the first slide, I'd like to bring you to the first slide on your left, which basically shows the global energy spending split by different energy sectors. So you can basically see that from 23 to 2026, we can expect a consistent growth in the energy spending at the top line, especially and most prominent in 2023, and we can expect a steady increase from 24 to 26. But if you look closely from 24 to 26, most of this growth is driven by the spending within the low carbon sectors, most prominent from solar and wind. While if you look at the oil and gas spending, you can see that the growth is actually rather muted in comparison. Okay, and on your right side, which basically shows the market shares by continents, basically you can see that Asia tops the overall energy spending within this period, 23-27. And you can see that, and then followed by the North America as well as the Europe. And out of these 36% in Asia, close to 70% will be driven by the China market alone. And that basically suggests how big the China market is expected to be over the next couple of years. And out of these 60%, from this 36% in Asia, will come from the low low carbon sectors alone, which is comparable to what we see in the Europe market as well, whereby 60% is actually driven by the low carbon sectors. So this suggests what we see so far from the pandemic. We've seen that the low carbon sectors, especially in Asia, has grown significantly at a lot faster rate, whereby now we are seeing that the split between low carbon and oil and gas is pretty similar to the Europe. And then in North America, basically 70% from that energy shares is actually driven by the shale development in the US. So 70% comes from the oil and gas sector. So this basically suggests that Asia, how big of an energy market Asia is, and that also means China. I've got a couple of slides on China later, which I feel that maybe there's a lot of interest on China market. And so this is just to show what we can expect on a macro level. So let's move on to the next one. I think this one is more relevant, so I wanted to put more focus on this topic. Just get it like this. All right, so starting off with the price of crude, Brent. So I wanted to cover a bit what we can expect on price of all these energy commodities, specifically oil and gas. So looking at the ICE Brent, basically this past couple of weeks, we have seen how globally connected the oil market is and how geopolitics matter. And basically, we've seen in a matter of few days after the Israeli-Hamas conflict, the oil prices went up to close to $93 per barrel from the level of $84 per barrel within in a matter of few days. And then, and that alone, despite not seeing any actual disruption in the demand and supply. So basically, that's the I would say the market psychology behind it. Especially on these commodities, whereby any kind of geopolitics situation, the first reaction is often overstated, and we see after a further reassessment of the situation, the prices will kind of stabilize, whereby we have seen that in a matter of few days after that spike in energy prices, oil prices precisely, we've seen that the price level dropped to $87 per barrel. And basically, that being said, it doesn't eliminate the geopolitical price premium altogether, because this possibility of seeing disruption in the supply is real, because given that the war is still ongoing, and it also whether or not there'll be any oil producers being drawn into the conflict. So that will definitely change the equation, but basically we expect that at this point it's a bit more localized, and that together with the extension of the Saudi supply cut, which is expected to last until end of this year, will definitely keep the oil prices elevated. And we estimate that the price would see an average of about $90 per barrel from the fourth quarter of this year till the first quarter of next year. And looking at the price of gas, we expect that the spot LNG prices of TTF and Northeast Asian will trade at levels of about $13.7 to $14.6 per MMBTU from 23-25, but overall we expect a rather healthy gas prices, and we don't expect much disruption from the ongoing instability in the Middle East. And this is mostly driven by the robust storage. By the robust storage in Europe, as well as a slow comeback of LNG in Asia, which has kind of eased the upward pressure on the price. But however, we expect that there's a continual tightness in the market, whereby any shocks in the demand and supply will kind of drive up the short-term spikes in prices. Okay, but this fundamental deficit is expected to last till 26. And in the period of 2030, we expect that there'll be an oversupply of LNG in the market. This is mostly driven by the waves of upcoming waves of LNG projects making FIDs this couple of years, and that will definitely result in an oversupply of LNG outpacing demand growth. But overall, I just want to summarize. Looking at the oil and gas, we can expect that all these commodity prices are expected to remain strong in the near term. So that will definitely give a positive outlook on the upstream business. Okay, so now I'll cover a bit on China. I find this topic quite interesting, so I wanted to put more focus on this. So, well, we know the fact that China is one of the biggest manufacturing as well as fabrication, and most of the across the supply chain, we can see that China is one of the biggest leader. So it's important to understand the story here and what's happening in China. And to do this, it's important to understand the manufacturing sentiment in the country. And looking at the Purchasing Managers Index, so PMI, which is basically an economic indicator that measures the health and performance of the manufacturing sector in the country. So this is basically helps to provide some insight whether or not the manufacturing sector is growing. So it has a baseline of 50. So anything that reads above 50 basically means that the manufacturing sector is growing, and conversely, anything that reaches below 50 means that the sector is in a contractionary mode. Okay, so looking at the trend that we can see here from 2022, we can see that for the past year, we can see that it was mostly contractionary. It was a very contractionary 2022, and we can see from the first quarter, the first quarter was positive with 3 consecutive months of positive growth, and that changed for the remainder of the year, whereby we can see it's fallen below 15 now. So basically, this suggests that. So this suggests that this kind of growth in the sector is actually in a very contractionary mode, and we expect that. In China, although they still have hopes of materializing the 5% GDP growth this year, although things are looking slow. And because of that, the Chinese government is expected to turn things around by providing stimulus and as well as debt, sovereign debt to the sectors. And that will definitely help to boost up demand, especially domestic demand. And this period of negative growth is actually contributed by a lot of things. The first thing is the subdued domestic demand due to a lot of factors, of course, but mostly due to the difficulties we are seeing in the real estate as well as construction sector, which has been whereby we have seen that the domestic demand is low, and as well on top of that, we have seen that the demand from imported goods have also declined a lot due to the softening of the global market. So because of that, we feel that, and that alone, we have seen its correlation with the overall, with the global industrial metal prices, whereby we have seen that because the manufacturing sector is consuming a lot from the world's metals. So we have seen that a strong correlation between these two, whereby you can see that the global in metal prices has failed to see any upward given the contractionary environment in China. Okay, so you can see from the price, the orange line there, it's not going up because the capacity of metal consumption in China is so much, but because of the contractionary outlook we are seeing, so it's not really giving any upward sentiment to the metal price. Okay, so now looking at it from a different angle, basically looking at it from the producer's perspective. Okay, looking at it from the producer's perspective via producer price index. So this is just to see whether the producers are getting any benefits from the strong inflationary that we're seeing on a global scale. Okay, but producer price index basically means basically it's an indicator whether the sector is in a inflationary or deflationary mode. It's actually an indicator in the early stages of the supply chain. Okay, so basically you can see for the past more than 10 months, we can see a 10 months of consecutive decline in the PPI, which basically suggests a deflationary outlook in China. And this alone has resulted in the producers not really making any profit from their selling price. So it's actually good in a way for the buyers that have been struggling with a lot of inflation over the past couple of years, because they can now benefit from the lower selling prices from the producer, but it's kind of pinching the producer in that sense. Alright, so now let's take a closer look on the international steel prices here over the three markets in the Europe, China, and as well as the US. Basically, we can see that in the first quarter of this year, we can see that there's an increase in the overall steel prices across the three markets, most prominent in the US due to the lack of imports in the US, which has been allowing the domestic mills to kind of increase the price a little. And this is coupled with the reopening of the China market, whereby we have seen it has kind of given upward trend in the price dynamic. But this upward trend in the price dynamic has kind of been curbed due to the excess production. So overall, we can see in the second quarter, the steel prices have kind of shifted to a bit downward across the three markets. But the good thing is we can see now the price differentials across the three markets have started to narrow, which is a good sign, because it's kind of helped to kind of give a boost to the steel prices in the coming few months, hopefully. Alright, so of course, this is kind of just to see how is it impacting the steel producers along the steel supply chain. So basically, we can see that overall, the 20% year-on-year drop in the steel prices have kind of affected the margin of the suppliers across the supply chain. We can see from upstream to downstream. It's impacting the hardest to the steel makers, whereby we can see that they are barely making any margin. And overall profits have dropped. You can see that it's mostly in the negative side. And especially the steel makers remain squeezed by their relatively more profitable raw materials producers. But of course, I just want to put this into perspective. Basically, the stimulus that the Chinese government are providing will definitely help the sectors, because we can expect that that alone will kind of boost demand, especially domestic demand, to kind of push this up. So we expect that there'll be an improvement in the steel prices moving forward. We don't really know what's the rate like, but that's our prediction. And also on top of that, the steel producers at the moment, due to this negative profitability, they don't have the capacity any further to provide more discounts on their product at the moment. Okay, so that's on the China market. And now I wanted to bring you through on some of the capacities across the service segment. So looking at the Christmas trees capacities first. So the first thing is basically this graph is showing the number of Christmas trees on order, and also the indicated maximum capacity range. One thing to note here is that the indicated the maximum capacity has changed a lot, has declined a lot from 2013, 2014. This is due to the oil price crisis in 2015, 2016, where there were a lot of plants shut down, and as well as M&A going on in the offshore segment. But we can see that what we forecast is going into the next couple of years, we can expect that the capacities within the Christmas trees supplier is gonna be tight. It's gonna be challenged because if you can see what we forecast is that the number of orders of Christmas trees will definitely be reaching the maximum capacity that we have at the moment. All right, so now looking at the offshore vessel capacity across these 5 type of vessels here. I have the description of each of these vessels at the bottom there. But what I would like to point out is that most of this growth in the offshore vessel demand is actually driven by the wind sectors. You can see, especially across the OCV, SOV, and WIV type there. And that also alludes to the fact that the segment for that specific type of vessel will be pinched, will be tight, and this kind of tightness as well is expected to push the day rates further. We expect an increase of about 10 to 15% of the vessel day rates, especially along this type of vessel. All right, so this is on offshore rig over floater and jackup type. Basically, we can see from the marketed utilization here. Marketed utilization basically excludes all the cold stack. So looking at the marketed utilization, we can see that the utilization is reaching close to 80%, which kind of indicates that the demand is growing at a lot faster rate than supply. So that kind of make the segment a bit tight in the coming years. That's what we expect. And also we expect that the day rates of some of the underwater floater type to see an average of to be pushed to close to $500,000, whereas for some of the harsh environment jackup to see an average of $140,000. And also most of the growth in jackup is being driven by the new greenfield developments, as well as a slight comeback in 23-24 especially, and the Golden Triangle of Brazil, US Gulf of Mexico, as well as Africa will continue to drive up demand, while the Caribbean and the North Sea is showing potential for growth. Okay, as for jackup, most of the demand growth that we are seeing here will be driven by the brownfield asset. There's short-term incremental production from brownfield asset, especially mostly motivated by the higher energy price regionally that we are seeing. Okay, and the Middle East will continue to dominate the jackup market in the near term, with Saudi Aramco recently doubling its jackup fleets, while we expect that the mainland China, India, and Mexico will continue their high degree of relevance in the jackup market, especially due to the requirement from their infill drilling. Okay, so this slide is just to show what we can expect in terms of the growth in the near term in 24 precisely. So this is kind of showing the comparison between oil and gas, as well as some of the low carbon sectors that we have here. Okay. All right. So basically, we can see that across the oil and gas value chain from upstream to downstream, we can see that the growth has been pretty much muted or negative. Or negative. So it's rather flat. And while if you look at some of the low carbon here, especially solar, wind, and as well as some of the carbon reduction technologies, we can see a huge growth in the near term. So this is actually a good transition opportunities for the suppliers to build some presence in the low carbon sectors, as these, especially when they share similar supply chain segments with the low carbon sectors. But I just want to highlight that on a year-to-year basis, right, the share of the oil and gas is still dominant. I would say 2/3 of what we can expect from the overall energy spend in energy investment. Okay, so now I'm on to my last part where I wanted to cover a bit on what we can expect regionally. All right, so this slide basically shows the energy investment split for across these different sectors for the top 5 countries in Southeast Asia from 23 till 27. Basically, we can see that in Indonesia, Malaysia, and Thailand are the top 3 oil and gas dominant countries with substantial spending in the oil and gas sectors, whereas Vietnam and the Philippines, almost 90% of what we can expect in their yearly energy spending will be coming from the mix of low carbon sectors. And this is kind of alludes to the fact that the greater dependency and priority of these oil and gas dominant countries to secure supply on oil and gas for power generation purpose and also for their country's economy. And for the low carbon sectors, basically, we can expect that this is actually motivated by their string of incentives provided by the country to kind of encourage more investment within these sectors. And basically, I just want to point out as well the substantial amount of spending investment that we can expect from the geothermal sector in Indonesia there. Because, basically Indonesia is home to about 40% of geothermal reserves. And we expect that, Pertamina through its PGE, through its subsidiary, PGE, Pertamina's Geothermal Energy, is expected to double its capacity by 27-28. So hence why we can see a huge spending there in geothermal. And on your right basically shows the top 5 operators across within oil and gas as well as low carbon. It's pretty natural to see the NOCs are driving the bulk of the investment in oil and gas. Whereas if you look at the operators within the low carbon sectors, you can see that these are mostly independent companies with a niche presence in a certain sector. Now I'd like to show a bit on the regional jackup market that we can expect in the near term, in the next couple of years precisely. So you can basically see that there's still a promising number of rig demand to be awarded in the next couple of years, which is a promising outlook for the regional rig players. And we also expect, if you look at 2024 there, you can see that the market will be a bit tight due to some disruption that we expect in the marketed supply regionally. And of course, you can argue that this rig demand is pretty fluid across region. But of course, it might not be practical to kind of have, if the rigs is in the Middle East or the North Sea, for example, it might not be practical to do that kind of long mobilization because of the cost. So it might not be practical to do that. So hence why this is showing what we can expect in the regional jackup market. Okay, so this is looking at the inflation across the service prices that we have. Let's focus on the chart on your left, which basically shows the inflation index across these key service segments in Asia. You can basically see in 2022, there was like a prominent spike across this inflation across these key service segments, most prominent in the drilling, subsea, as well as maintenance and operations. And you can also see from your right, which basically shows the segment changes in 2024. We expect that, we expect that going into the next couple of years, this inflation will be pretty much remain elevated. We don't see any dramatic escalation. That's a good sign. However, we expect a slight drop in 24 across some segments, such as seismic as well as well services. You can look at the segment changes here on a year-to-year basis. You can see how big the inflation that we can expect, especially across drilling segments and some of the well service, and as well as some of the EPCI segments. So I'm on to my last slide. So this is kind of showing what we can expect on the labor market, especially within the EPCI segment. Basically, we can see that looking at the EPC cost drivers, the way to do this is you just want to do counterclockwise, so reading it from the first slide over there. So the EPC cost drivers is expected to stabilize going into 2024, which is a good sign. This is mostly due to the most of the material prices have started to stabilize from the peak of 2022, such as steel, because steel was seeing the highest inflation in 2022. Okay, and moving into the last one, the bottom one there, which basically shows the labor cost or basically average hourly wage on EPC segment across 6 different labor markets here. We can see the top 3 lines, which are basically showing the labor markets in Japan, Singapore, and South Korea. You can see a prominent rise in its labor rates, whereas if you look at the bottom 3 lines, which are basically showing the labor rates in Malaysia, Indonesia, as well as India, we can still see that slight upward trend, but it's not as prominent and it's almost flat anyways. So that gives them some competitive edge when it comes to providing labor support, especially on labor-intensive segments such as EPCI. All right, so on your right basically shows the service price inflation, the main driver to this service price inflation we are seeing. So most of the inflation we are seeing in the next couple of years is expected to be driven by the labor focus segments here, whereby you can see that the trend is mostly is very much upward. Whereas if you look at the material focus segments, you can see that it's also sharing the same trend, but it's not as high as labor focus segments. So what we can expect really is both of these segments, labor focus and material focus, will definitely be pushing the service prices further over the next couple of years. But the rate that the labor supply segments are pushing this inflation will be a lot more than material focus segments. All right, so now I'm on to my conclusion. So 5 takeaways for everyone. Well, we can expect that the global service suppliers or oilfield services are expected to see improved margins overall. This is good, a good sign considering that they've been having issues on all of these due to the pandemic. But of course, this is also a good sign that now they have more capacity to grow, and after a few years of returning their free cash flow, we can expect that there'll be more M&A over the next couple of years. And second is the oil and gas sector continues to see influx of activities provided by the boost in the oil and gas prices due to energy security at the moment. But we don't expect that these activities to be any higher than what we're seeing in 2023. We feel that it's going to be more or less similar. And the third one, the China market reopening proves to be rather muted than initial expectation. But of course, there's hope in that because with the stimulus that the Chinese governments are providing across its domestic demands, we can expect that there'll be an increase in demand, and that will definitely help to push some of the prices of commodities, especially metals. And the fourth one, growth in Southeast Asia so far is promising, especially within the low low carbon sectors. There's a lot of opportunity within the low carbon sectors, and most energy service segments are showing clear tightness at the moment. It's a good sign for the suppliers, of course, but for the operators, they might be some challenges to secure supply, or maybe seeing some increase in their service prices. And last but not least, the Asian labor market will continue to drive most of the inflation. So far, from what we are seeing, especially on those labor-intensive segments, we might expect some escalation in its prices due to the higher labor wage that we are seeing across most of the labor markets. Okay, so that's about it, everyone. So I guess I can take some question from the floor. Yes.
You don't get me walk away.
Yeah, thanks. Great presentation. I appreciate your coming in tonight, and thanks to RISED for having you here. On that last section on the labor market, are you distinguishing between increase in salary versus a lack of labor force or reduced labor force, or do I not?
You mean the bottom slide there?
Yeah.
Okay, that's basically just showing the hourly wage, but we don't actually monitor the productivity. I think it's you're comparing between the quantity of the number of laborers with the productivity, right?
That's right.
So we don't, at the moment, we don't have any measurement to kind of measure or quantify how much productivity we can expect. So that exclude that. Also, I believe on that end, when it comes to productivity as well, it includes all this technology, right? So we at the moment for this per se, we don't take that into account. So this is mostly just looking at the labor rates via hourly wage.
All right, thanks.
Yeah.
Thank you. Any more questions from the back?
Since the major IOC have been downside their business in this region or even move out from the Southeast Asia, will that affect to the labor market also?
Sorry, come again.
I mean the major IOC like for Chevron, like
Okay.
have been like downsized or even move out from these regions. Will that affect to the labor market in Southeast Asia? Because this one is it really reflect to the current business in.
Yeah, this is basically looking at the current trend. So we don't kind of we don't like speculate or forecast like who's leaving or not. So this is purely quantifying the cost drivers via labor rates, labor wage precisely, and as well as the material segments, the spot materials prices. Yeah. I can. Okay.
Anyone from the back? No?
Okay. I think my colleague, you wanted to kind of add on to the question. Yeah. Okay.
Thank you. So, as Afiqah showed on the slides, the positive thing is that investments are still continuing, irrespective of the players exiting, and most of the activity trends that we see, at least in the near term, is going up, which reflects that at this point there is no significant risk as such. Even if there is a transition towards different focus areas, if not oil and gas, that would likely create a bit more opportunities rather than significant reduction in the labor market. Yeah.
Thank you, Pratik. Any other question from the floor?
Any more?
Maybe one last question.
One last question. There you go.
Okay.
Yeah, back to your slide, there was one slide that was showing that the renewable investment in Vietnam was way more than both Malaysia and Thailand. So I just wonder what...
The renewables,
Yeah, renewables.
in Vietnam.
Yeah, compared with oil and gas.
Okay, so this is mostly attributed by the investment we are seeing within the wind and solar segment. Wind, because in Malaysia is not really practical for wind because of its location near to the center. So because of that, it's not possible to harness this wind energy. So, but even Petronas has deemed that impractical to do in Malaysia. Hence why. So, and most of these investment we are expecting in Vietnam and Philippines are also motivated by the string of stimulus and also incentive stimulus and all these policies that have been kind of relaxed by the government to enable more independent and international players to involve in their renewable sectors.
Yeah, so that means Malaysia and Thailand is behind in their stimulus for renewables compared with Philippines and Indonesia?
At this point, yes, because from what I've been tracking before, we don't really see like a complete framework on how the government is kind of subsidizing these sectors within the countries at this point. We can like talk further if you've got any info on this, but from what we've been tracking so far, the renewable sectors in Thailand is a bit limited to mostly solar. And a bit on CCS. So, yeah.
Okay, thank you.
Hope that answers.
Okay, any more? Any more one? Any more two? Any more three? Okay.
Okay.
Thank you.
Thank you, everyone.
Yes, I think Afiqah and her colleagues still around after the meeting. If you still have more questions that you would like to ask in person, feel free to talk to them.
Okay.
Okay, and on behalf of SPE Thailand, I would like to have Kun Anupong please present the token of appreciation to our speaker tonight.
Feeling like a SP board try to promote dual role tonight, MC and token appreciations. Okay, all right, let's come to closing remark for tonight. Okay, for the next meeting in January, so we skip next month, December, due to the Christmas and New Year break, right? For January, we have guest speaker from Chevron, petroleum engineer, Khun Khom San, in the topic of innovative artificial lift techniques to overcome challenge in the Gulf of Thailand. Very interesting topic next time. Okay, and next one. So we just announced the 15 scholarship for students that the student came from many universities, Chiang Mai, Chulalongkorn, Suratnari, Queen of Songkhla University. This is one of our events that we contribute to student chapters. Okay, next one, the grand event, SPE Thailand ENP Award 2023 and 2024. Now the abstract open for the submission until February. Right, the criteria already announced in the SP announcement by the email or even by the line applications. Let's see how is the project look like for this year. Okay, this one, that is the promote of the SP Asia Pacific, SP International Events in Asia Pacific. The next one, the event that going to be held in Thailand, that is gas field development and production state of play on 15 and 16 January. The abstract now closed already, still under the selections. and going to going to be held next year, January. And next one, this is very close with just next 2 weeks time on 30 of November, SPWLA Bangkok chapter. Right, speaker here. Oh, welcome. Okay, and another grand SPWLA conference 2024 as well. The abstract submission still open with the deadline submission on 29th of March. Okay, next slide, please. Okay, this is almost last one, right, for the event. We're going to have many activities, very active event in Bangkok. Actually, this is before last one. Okay. IADC or Asia Pacific Drilling Technology Conference, which is hosted by PTTEP, right? It's going to be on August next year, about 8 to 9 August next year at Central Grand. No, Central. Okay, next slide, class. Okay, just remind the paper submission date on 20 of November. 1 week left. 4 more days. Okay, this is last one for the event and very interesting event as well. ASEAN International Energy Summit. Right, we have keynote speaker confirmed, which is Khun Mantri, CEO of PTTEP. Also together with Executive Vice President from Upstream Petronas and Upstream Director for ENI, and especially additional global recognized speaker for Mr. Sean Gates, CEO of Vera and Sean Gates with Vera Energy. Okay, they open for the abstract for submission as well for the award, right? And this before last one for just keep connection together, keep update together by our Facebook, Line, and especially Line officials. Currently, not only we make the announcement by the email, we also make the announcement by Line application as well. Last one, lucky draw. So we have a special gift, lucky draw from Rystat. Very nice tumbler and adapter. Okay.
How many price? 2, right?
We have 2 prize, so
Maybe one at a time. Okay.
Jiang Ziyong, we fig.
Refik Chang Siyong.
You're lucky.
I think
Yeah, we got one more.
you have to.
Oh, you got 2 more. They got another.
We got another one. You can give the back
Give the
as well. Oh, okay.
Yeah, okay.
All right.
Yes. Photo, please. Photo. Okay, second prize.
Yeah, satu lagi.
Satu lagi.
Oh, help me to pronounce.
Company first.
Company first. OEG.
OEG Offshore. Sirirat Santarkan. Sirirat.
Sirirat 1.
Sirat 2, Sirat.
You.
Ah, all right. Okay.
All right, this is come to before last slide that thank you for our sponsorship. If your company logo is not there yet, please contact with our board to sponsor. Please give our applause for the sponsor. Okay, and last one, secret code. Right. ไม่มี 241 downstairs as usual. So, thank you for your time for tonight, and see you on January next year. Thank you ครับ
All right, thank you. I feel that I don't know why, because I was like keep looking at the slide and somehow my yeah. So after that.